I would like to introduce the panel just very quickly. So nearby me, it's Vytautas Žukauskas. He represents the Free Market Institute, a very good member of our panel. And Oliver, you've been, presented. So Thomas Kontautas, he represents Sorainen as a partner. And Martin van der Belt, you've been, and Vytautas as well. So this is probably the most exciting topic. We've heard a lot about the word regulation was sounding probably, most frequently in this conference. And I would say that that's the issue we have to discuss really. Let's just start from blank page. The issue before us is regulation. I mean, do we need it? What type of regulation we need it? And the rules, the rules in Lithuania are probably strict in some respects. They are, in some respects, they're non-existent, and their experience is not yet here. And I hope the panelists will make their own arguments about it, and we can draw some sort of thesis, or we can at least draw some conclusions whereby you, as the audience, can take a message that you're seeking about this industry and how it should be regulated. So let me start by basically, going to the main issues that I think are important. UK is like 75% of the market in the EU, and the rest of the countries, which is like a block of 28 countries, is only 25% of the market. And they have very favorable regime, which was actually introduced very late stage and induced by the market forces itself. They've sort of have a bottom-up approach, and they very carefully crafted regime. Our neighbors in Estonia, they don't have regulation whatsoever in this field. So I would like to ask our panelists about your approach to regulation. Do we really need it? I mean, and can the market regulate itself? And that's what's your opinion, Vytautas?
Yeah, it's a very good question. The reason why I'm on this panel because I've been involved in discussions in the consumer loan, basically regulation in Lithuania since 2010, when we had to fulfill that directive of consumer loans, and since then there were a lot of problems in Lithuania. And yes, of course, as someone from an institution who's called Lithuanian Free Market Institute, I have to, and I do really believe in self-regulation, at least to the most part. But I think the main issue here today is how much our regulating institutions do believe in that. And I think this is the task we have to talk about that today, because to my understanding is that in only very few instances it is like that that regulating institutions believe in self-regulation. Because why I'm saying that? Because when we think about crowdfunding activities right now, we are in a very early stage, and the regulation is not here. But of course, there are already some regulatory initiatives, and one of them is to put the credit-based crowdfunding under the consumer law. And this is one of the draft laws which are being right now discussed into the parliamentary group. Of course, it's not the final draft, but this is one of the proposals, and I think we have to discuss what would be the implications of that for the crowdfunding activities, because the business model is here, we are all very optimistic, but what is going to happen if we put these activities under the consumption credit law? Because why I'm a little bit pessimistic is because since 2010 I'm seeing what is the political will to regulate these activities, and it is very, very harsh in the sense that the main point of view from the regulator is the protection of the consumer. I mean, there are, of course, all these stories where people are taking too many and too expensive credits, and they are, of course, going bankrupt. And this is one of the main reasons why the regulation is always trying to be made stricter and stricter. And, for example, this new draft law, which tries to put credit-based crowdfunding under the consumer law, it has some such parts as, for example, 2-day calm down period, in the sense that the institution cannot give credit for 2 days. And this is very interesting. You said that you have very good value for money, for example, model, and this is very great. But what is going to happen, if we have this notion? The second thing is, for example, that in this new law, one person can only have 500 euros per year for one project. I mean, so these are all these kind of regulations which fall under the consumer credit, but of course they are trying to be applied for the credit-based crowdfunding. So for me, it's very interesting how it's going to be. Also, I would like other panelists to think if it's the case in other countries. So I think that's the main problem, because I see this as a very new way. The shared economy, new way is I think it's not only in credit, but also in hospitality services everywhere. And I think this is a very good instance for the regulators to rethink whether we want to really decrease, not increase the regulation. The way it is being done in Lithuania, the problem is try to be solved in squeezing the new activities into the old regulation, which is being made a lot stricter. So this is, I'm very pessimistic with the model. I'm not so positivistic about the regulation part. So this could be my start.
Yes, so of course I don't know the proposal in Lithuania or the market in Lithuania, but basically on a European level we have a regulated European market in financial services, and if Lithuania is part of the European Union, which it is, then the European laws also apply here, and under the threshold the European Commission and the Parliament and the Council have set, there is the freedom of interpretation and for national member states to act. And within that freedom, we already see today incredible differences in what is possible and what is not possible. The UK is being quoted as one of the examples, which is very liberal. It's also a market where maybe the banking system isn't as, or the local banking system is as evolved as in other countries like Germany also, where we have very, very strong saving banks. And maybe less demand for consumer loans at that level, and also less trust. But also it's a culture of investment in the UK, which is very Calvinistic, very Anglo-Saxon. Again, in other countries that is not the case. So there's certain factors that come together, and the UK regulator has looked at the market for a very long time. The first platform was opened in 2006. They actually came up with a regulation only in 2014.
That's the thing, they introduced it very late in the stage, and they let the market mature a bit and work, and in that sense, and that's my sort of question was in mind, do we really need it? Like, for example, in Lithuania, as Vytautas was pointing out, we have a law which is a very old law, existing law, which targets specific area, consumer credit, and they want to regulate it in the auspices of that law, which is not really at least to me it doesn't sound like innovation. Martin, can you add something to that?
If I can make a suggestion, if you think that the UK is the model to follow, there should be two things happening here. I think the industry itself needs to be getting its act together, and Jens also mentioned it already. The industry has to share things and has to share a couple of principles, operating principles. So I would say, get as early as possible organized as an industry through an SRO, a self-regulating organization. And then the second thing is you should talk to your politicians and say, listen, we want to have this to grow the economy here in Lithuania. Not only protect the interest of the consumers, but also grow the economy, create jobs, etc. And you talk as politicians, either through ministries or whatever, to the regulator, and make sure that at least they apply the most dirtiest word you can ever have a regulator say, which is light touch regime. And that's exactly what happened in the UK. So they have taken themselves some time to look at what the development in the market was. But I think those two elements together, the SRO element as well as the light touch regime initially by the regulator, gave the market the momentum which it has, apart from a lot of other, very positive factors which make that the UK is going through a perfect storm.
So that's actually an interesting point, because regulation Lithuania, although they're introducing it into an old law, I mean it's very how to say, very basic in nature. There is no certain there's only framework. They try to limit you in some way, but for example, they oblige you like a platform to be fair, like avoid conflict of interest, have a certain amount of capital, but beyond that, they don't go anywhere else. So that's, you know, the emptiness of this regulation is sort of striking. They just want to sort of keep you regulated in the list so that you are like on the radar, you get compliance. That's what you will be obliged to do, but then apart from that, there are no sort of substantial obligations. So that's, you know, what struck me about it mainly.
Maybe I would add, if you look at the background where the regulation emerges. Usually, if you look from economic theory of regulation, the state has to intervene into areas where market economy doesn't work. So earlier, if you look pre-crisis regimes, there was a big expectations that market instruments are working.
Yeah.
And during the crisis, all the financial sector suffered, and afterwards, heavy over-regulation, because lots of politicians, lots of regulators thought that market instruments do not work in this area. So somehow, if you look at crowdfunding as an instrument, it's also a consequence of financial crisis, because crowdfunding went to the areas where the traditional banks were not lending due to some conservative approach.
An opportunity. Yeah.
And somehow, as a new, so to say, new initiative, crowdfunding also drags behind this old attitude that it's within the financial sector, it's still dealing with consumers, and it's still everybody remembers the experience that something went wrong in the past. So looking at this new, so to say, new initiative, there are lots of questions from politicians and regulators to what extent we go. And I think the choices are three. One is to forbid, another is to allow function how market functions, and there is something in between called regulation. So regulation not necessarily is the worst idea.
So that's, you know, what seems to be, it's interesting to actually understand what's their motivator behind the regulation, as you're mentioning, because the national bank seems to be running on fear of fraud, of essential things that, you know, that's why they want to keep it to a limit. And I would like to ask Vytautas, I mean, you've created Savy out of scratch, and you've created a legal structure to sort of avoid the current, you know, limitations, or, you know, I'm talking about deposits and I'm talking about money transfer. Maybe you can share your experience about, you know, how you've dealt with the regulation here.
So I just wanted to have a couple of comments on the regulation side a bit. I liked Martin's yesterday during dinner. He said, don't have a dream that you will not be regulated. So we don't have this dream that we wouldn't be regulated, and we stand strong for regulation. And we stated that in the beginning of our launch last year. The main principles that we want from regulation is clarity and possibility to grow the market. And too many limitations, what we see currently in the draft, might kill the industry before the launch of the industry. So this is the main fear that we are fearing. I think we will elaborate on this topic more. The structure that we have in Savy, actually, we couldn't find any other company in EU working as we do, because we don't collect any money and we don't have any escrow account or deposit account. So basically, we link different accounts of investors and borrowers, and we make transfers directly. So we don't collect money. And this makes a really difficult environment to operate, because we don't have any possibilities to make mistakes, because we are dealing every day with direct money transfers. And it's very risky to do that. We don't have any other possibilities, because if we would start collecting money from investors, we would be counted as a bank or as a credit union. And then the financial institution regulations come in, and then you have to have enough capital to lend money, and this is not a feasible way to think about it. So from our perspective, we started this market in Lithuania. This market could have started 5 years ago, easily. But we were the only ones who figured out how to manage to avoid this deposit banking regulation. But it's not, it is the thing that we created. I wouldn't say that it's the best thing that we could have in Lithuania, but we have what we have. So, yeah.
Let me go to more specifics. For example, I mean, we're talking about the regulator's approach here, and I think it's really important. For example, in the UK, they are diversifying the pension plans so that ISAs include peer-to-peer. Here in the old consumer law, which will incorporate crowdfunding, they are prohibiting, like a physical person is prohibited in investing in loans, although they make a definition in a different page of that a physical person, a natural person, is actually a lender. So they confuse, loan and they confuse consumer credit in two things. What do you think generally about the approach of the regulator in Lithuania? I mean, in terms of...
Well, we have 2,000 registered investors in our platform, and we have, it's their opinion, not ours opinion. So we have the survey, and basically, they don't care about the regulation. It's their opinion that we think that it's legal, we can lend money according to civil code. And they want from us the clarity of our platform, and they want from us information, disclosure of certain things. But the main thing that they care about is the tax implications. And there is any dialogue in the draft about taxes. So basically the investors, they care about, it doesn't matter if we speak about peer-to-peer or we speak about the crowdfunding. If the natural person will lend to other company or physical entity, he has to know what taxes he has to pay.
Yeah,
and
that's an important issue.
That's the main issue for all the investors. So I'm speaking on behalf of them, not on behalf of the platform. On behalf of the platform, the draft that we received last week has 3 major flaws in our opinion. Mm-hmm. One, the limitation of money, that the investors cannot lend more than 5,000 euros a year. Second, limitation of the amount of money to one loan, that's 500 euros. And third is that the platform would receive the money, the commission, only from the cash flow of loan. So basically, you have to have really strong capital base to enter this platform lending business, and you have to prepare for long-term investment here. And I don't see any normal business if this draft is approved.
So let me ask you, other panelists, maybe for your comments about these limitations that the law is setting up, and about limitations to investing generally. Like, what do you view? Because this crowdfunding and peer-to-peer lending, it gives choice to the person to do something with his own money, which he hadn't had otherwise, right? And now the activity is limited. So maybe, Oliver, you have a comment here about it?
No, this seems to be a very normal approach in a number of countries. So in the UK, I think we have to leave it aside. We are not in the UK here. We have different settings, or the lending businesses here considered a banking activity. In the UK, it wasn't. So the market could evolve. So if we leave the UK out and we assume that your regulator will not take the same approach, then you probably have something that they looked at what the French regulators did for lending, where they created a cap and per project, but also per investor, and where they basically looked at a regulation that lies somewhere between the actual banking license and below, with a low capital requirement, adequate for the market. And so, I mean, maybe this is where they get the inspiration from, and maybe the French market was already further developed, and you had platforms, already in the market. I mean, you had at least activities there for several years in some forms of crowdfunding where you can learn and where you can build something. And I don't think you have that here. So you potentially need something that enables your market to grow first. But you don't have the 10 years that the UK had. Huh?
Yeah, true. Thomas.
I would add something that if you look at our regulator, it's not a regulator which used to be 5-6 years ago. Now we have pretty modern and cooperative regulator, and we're talking about the provision. It's an initiative. It's not a final piece of the law which is already enacted. So here we have to discuss and submit our proposals based on international practice.
Yep.
So I believe we are in a good stage, and this conference is in the right moment to give our insights. And actually, when you talk about this regulation, I think we should look. The regulator looked from a broader perspective. Crowdfunding is just one of the means to finance SMEs. The real essence of this legislative proposal was to find all other potential ways how to attract capital to SMEs. For example, Lithuanian joint stock companies, they're not allowed to issue bonds. One of the legislative initiatives, which is in this current, so to say, piece of paper, is also allowing the joint stock companies issuing bonds. So crowdfunding is just one of the area, and you have to also look
in a wider perspective,
right? Wider perspective.
Yeah, just to add a little bit up, I definitely agree with Thomas, and I definitely agree that the approach of National Bank is very well, they're good, because what we experienced last year is a really natural dialogue. We explained how we work, and National Bank looked at it, how we work, and he could actually just say that no, we prohibit that, but he really saw that we don't impose any risk on the market, we don't collect any deposits, and it's a really good way to it helped us. We are in favor of regulation because it will give us more capital, more investors will trust the platform once it is regulated. But we are not for too strict limitations. And if we say that we should see the platforms as a normal way of borrowing money in the market, these sanctions, like not sanctions, but requirements would limit this alternative approach. Yeah. So companies wouldn't be able to actually borrow big amounts of money because there would be no liquidity in the market. So this is what we speak about. So we should have main principles of regulations, but we should set the caps either higher, either move this cap setting to lower level of laws, because once we will have it in the law by the parliament, it will be very difficult to change it. So maybe we should move it like to governance of the National Bank or whatsoever.
Thanks for your opinion. I understand that these are local issues, and Martin, you've been dealing with regulation in your own business, and you've been actually working in emerging markets, which are like totally different from their distant markets. And what we're discussing here really is access to capital in many underbanked markets. So how do you view regulation in that respect? How do you ensure access, that regulation doesn't infringe that and impede that?
Well, as I said before, I think you have to accept regulation at the first place. So, and then you have to engage as quickly as possible with the regulator to make sure you are the first mover. In fact, you are already here on the back foot, it looks, because the regulator has put on the table his first offer. Yes. Probably it looks like it's a negotiable offer at this moment. But it means there are already two caps built in the industry. You should say as a local industry, yes, we're happy with a cap, or we're not happy with a cap. And then come back jointly as with those arguments. But another thing where you have to think about is how much market is there for online platforms in a market where there is 3 million people living? Is there a place for 10 players? Is there a place for 5, 4, 2, maybe none? Maybe there's not enough scale here. So you have to bring that element also into the whole discussion.
That's the point, because I was mentioning that a lot of those initiatives, I mean, what do you regulate? They want to introduce the list of online platforms, and there's like nobody on the list. So that's the regulation for the sake of regulation. That's the thing that I was.
I think this is actually something fairly sad in national politics across Europe. The crowdfunding industry doesn't hardly exist. I mean, it exists in the UK, and it is we've seen some examples where platforms have scaled, But overall, it doesn't exist, and we haven't got dedicated regulation to crowd lending activities. We have banking regulation and so on that applies. And the European Commission, for once, and it's an exception, has been on the case very early on at a time where the industry is just developing, and made a very strong statement early last year that the European Commission would like to look into this and like to learn more about the market, and makes a recommendation that no national regulations are being put in place, but that we learn about the market and that we then can put forward a recommendation to what can be done. And since that, regulation has been put into place in the UK, in France. They're talking about it in the Netherlands and in Belgium and in Spain. So despite the efforts by the European Commission to keep the market open and to maybe have a chance to discuss some level of harmonization at some point, or some key aspects that could be similar across the European Union, we see now one regulator after the other one trying to establish their own opinion in their own country. And that is detrimental for an overall industry across Europe, because once you have Lithuanian regulation, you have to operate under that regulation, and it might not be beneficial to expand abroad. And then you cannot scale across border, or it will be very costly. And I think this is something that maybe the regulator should rethink as well. We have the opinion of the Commission. We have the opinion, we discussed that already earlier on, of the European banking authorities, which clearly says they don't think that crowd lending or peer-to-peer lending is a deposit business, and therefore it's not a banking activity. And therefore, the problems that you have, you shouldn't actually have at that level. But the national regulators are not bound by these communications, so they still can do what they want until it becomes a European directive and law, which takes many years, and then again needs to be signed off by your national government. So I think this is something where the Lithuanian regulator might actually be well advised to take a step back, rethink it a bit, and start with, if they want to regulate something, not even a light touch. I mean, the market is regulated. Yeah? What they now need to do is enable it to grow while protect consumers. And I would agree, this can be done, A, by certain measures from the regulator, but also by, and we heard that early on, self-regulation, in particular about transparency. If you can talk about the data, the number of lenders, and so on, if you can make this transparent across all platforms that operate, there will be a better understanding of the market. The regulator will feel more at ease. There might be comparison possible to other countries, and then you could take a step forward in 1 or 2 years.
Yeah, Mark, maybe you would like to add something before, because we know you have an early flight. And,
I think one of the things which I picked up in our conversations yesterday was also that Estonia doesn't have a specialized crowdfunding.
No, and Estonia, like if you go to this Cambridge report that Arturas cited earlier, Estonia ranks second by per capita invested amount after the UK. UK is about 36 euros per person, and Estonia is about 16. So that's
so how do they do it?
Well, they have several platforms, and it's a purely civil procedure. I mean, when we're talking about that there's no regulation, there actually is regulation. There's a civil code in place which says, you're free to contract, you make loans, you make contracts, and you regulate your own affairs. So it works fine. I mean, in that market, and it grows very well. I mean, of course, you need a certain level of culture, probably, and a certain level of, certain people and a certain society. Here we have a very different setting where we, lag behind Estonia very much, and doesn't seem to change anytime soon. That's what I see. Maybe
I would like also to add that I'm pretty sure that we'll find a way to solve and find the best legal regime for regulating this thing. So regulate is only one step towards passing the law. Then you have a parliament. And in parliament, I think it's really much, the perception is such that still in a standard parliamentarian point of view that all crowdfunding, especially peer-to-peer consumer lending, deals with this very sensitive part of population who are taking consumer loans, they're taking another loan to refinance. So I guess it's also a challenge for the crowdfunding industry to demonstrate the benefits like raising money for socially important projects, and to demonstrate how they are going to cope with such a risk that the people who are not really, so to say, capable to repay the loans are not taking the money using the crowdfunding instruments. So I think it's a challenge for all of us.
So that's, maybe I can add, that's a very sort of difficult issue here, because we're talking about a new thing, crowdfunding, which is a new sort of innovative thing, right? And we want to regulate that in a law which is specifically dealing with consumer credit. And it has bad publicity. I mean, there are payday lenders, they need to be regulated. For example, there is an initiative for the people to cool down, as Vytautas mentioned, and other things that are happening. For example, people are gambling. They want to take a credit to help them sort of make another bid. So they want to prohibit night lending. And there is this initiative. So my worry, and I don't know, how do you think, Tom, about this, you know, so that we have to battle. Thanks, Martin. I know you have to leave. Thanks for joining us.
Also, if you look on European level, I think all regulators and all, well, so to say, countries make one mistake. They try to look at the crowdfunding from the existing financial perspective, which was designed completely for different things.
Absolutely.
For deposits, well, financial instruments, whatever. And currently, everybody is trying to, at least trying to regulate crowdfunding using this regime, which is adapted for this another type of entities.
It's whole discussion.
So the question is, why shouldn't we look at the crowdfunding platform as a special beast and create a special law for that? Because putting in a consumer side, okay, I understand it from regulator side, like crowdfunding will never pose a systemic risk for the state. The state won't collapse if crowdfunding platform collapse. But consumer protection, of course, it's a very big interest from well, regulator responsible for consumer protection. But taking into account what I said earlier, I believe that to look at it as a kind of special beast which has to regulate it separately, I think would be the best approach.
That's what I think. What do you think, Oliver?
I think the whole discussion about the consumer and the credit scoring actually brings us back to the UK. And this is maybe a job for the Lithuanian regulator then. In the UK, peer-to-peer lending can scale that much because you have credit scoring for the consumer. And the data on the consumer credit is available in an instant. And so there's enables the crowdfunding platforms that do consumer lending to actually know their customer and know their credit history, and they can, based on that information, or to calculate interest rates and have a fairly good estimate of their potential default rates, which is why they are kept very low. Now, if this type of credit scoring for consumers doesn't exist in Lithuania, and it doesn't exist in many countries in Europe, then that would be a job for the regulator maybe to initiate something so that you have appropriate credit scoring on which basis then crowd lending platforms can also operate. And then you don't have the issue anymore about potential fraud, or, you know, because the issue of know your customer is being solved through these systems. And this is something what the UK has exploited very, very good. And in other countries it doesn't exist to the same degree.
Thank you. Vytas, maybe you have to add something? You know, if you were to be regulated by a law which has actually bad publicity, I mean, would it be, I mean, what's your approach to that? I mean, how would you do that?
Well,
want that structure?
Basically, when we started, our approach was very simple. We follow all the main requirements that is entrenched in this consumer credit law. So basically, we follow the debt-to-income ratio. We follow that you cannot borrow to, you cannot lend to a person who has open debts, etc., etc. So basically, we came into the market, and although we were not regulated, we said that we will follow these requirements. It's not an issue with this particular topic. I think the issue is that there's no institution in Lithuania which is currently have like authority to actually check whether we are doing that. And this is where the problem comes in. And probably the National Bank wants us to be under their influence, that they would have the possibility to influence our decisions. And it's okay with that. We don't see any problems with that, because we are a basically public company in the sense that we give a lot of data outside. We say what our results are, investors, what is the loan amount, etc. Because it's a business based on trust. And we stand for basically main principles of regulations. I totally agree with Thomas that separate law of platforms would be best in this particular sense, because it will make more clarity that we are speaking about specific lending method based on platforms. And we can have links in this law that you have to follow the consumer credit law, etc., etc., etc. And that's fine with that. But we shouldn't mix two different things, because platform lending is not only about consumer credit lending. It's also about HELOCs. It's also about mortgages. It's also about lots of different SMEs, etc., etc.
That's it brings us to another topic then. Marketplace lending, as it's called in the US, it's all about choice, really. I mean, here, for example, a person in Lithuania can freely invest in stocks. He can freely invest in bonds, or buy a house, invest in real estate and get income, from there. But there's a very weird rule in the consumer law which says you cannot invest in loans. And marketplace lending actually creates a new asset class of investment as such. And Vytautas, maybe you can share your view on that. Why is that? The National Bank seems to be having this approach, and they don't seem to be changing their basic approach that loans should be only accessible to banks and financial institutions, and they want to limit that to private individuals by things. So doesn't that impede choice?
I think we have to clarify what exactly what kind of limitation are we actually talking right now, because I think there are two different kinds of limitations. The one, who can own a platform? Can a platform be owned by a physical person? I think this is banned from the law, or consumer law, because the reason for that is because in 2010, when we created the consumer law, and I was giving comments on that, the directive itself did not specify or did not ban the giver of a consumer loan to be a physical person. But it was then created in the law in Lithuania that it has to be only a legal person. And I do not know the exact reason for that, but my comments were not taken very seriously. And since then, it is in the law. And I think the reason why it is the same provision is taking right now in the law is just because crowdfunding, credit-based crowdfunding, is trying to be squeezed into the right now legal framework of the consumer credit, which is right now. So this is one provision. The second provision is actually that, as I understand current draft of the consumer law and crowdfunding law, it is that a person who is who's actually giving a money, it cannot be an institution. He can only be a legal person. I mean, the investor itself. So this is the second provision which we can think about. And of course, if we were talking about institutional investors, as I understand the current draft, this is something which is trying to be banned, I think. So this is the second thing we have to talk about. And the reason for that, I don't really know. We have to discuss that. And I think I really wanted to also to give a little bit. I think it is very crucial for the private companies to have a very thorough communication with the authority, regulating authority. I think this is one of the very, very big problems, because there are these discussions organized in parliamentary groups and etc. And sometimes the representation is not there, and I think it's a very, very big problem. I am a person who's being there, and sometimes it is very difficult to represent all the people that are in the market actually, and this is where the decisions are being made. And if the companies are not expressing the problems there where the decisions are being made, of course nobody is going to take our discussions seriously. You have to be there in the discussions, and you have to also be there with a paper that says, this is bad and this is why.
Thomas, maybe you have something to add about this choice bit. I mean, fine legal point here is that the law basically doesn't allow you to invest in consumer loans, but on the other page, you become the investor in a loan. So isn't there a legal contradiction here straight away?
But again, I think we are talking about a proposal, and there are lots of ideas which will pop from the industry, and I'm sure that pretty much of ideas will be taken into account. But finalizing, so to say, the legal approach, I believe that systemically, well, if you look at the system of the regulation, it would be really better to have a separate law on crowdfunding because it's a really separate instrument.
And then another thing about, maybe a second point about institutional capital, because the law, as it states here, prohibits institutional investors from investing in this business. That's kind of weird, and why is that?
Well, I think again it would fall under the further clarifications, but the core understanding, if you look how the consumer, this consumer law functions, that if you engaged into as a kind of legal person investing into the loans, into the private persons, you already consumer credit provider, and you already have to be regulated by yourself. So if you do it yourself directly, or if you do it on systematic base using the platform, it might be so that the regulator saw the same, so to say, background there. But I was not there, I cannot prove. But so I think there should be clear delimitations from the person, from a legal person who puts one or two kind of pieces of investment, and from the legal person who does really systematic, periodic way, and its core, so to say, focus and core essence of this activity, it's real consumer credit. I think this delimitation will have to take place.
Vitas, your comments?
Yeah, basically our comments like from platform is that we like the Jens approach that it's really philosophical point of view to think about peer-to-peer as people to people, and that's European actually approach, except of a couple of companies in European Union. In United States, as Matthew earlier pointed out, we have different approach that institutional capital has to participate, and presently it accounts for probably 80% of peer-to-peer lending platforms. Our point of view is we shouldn't have any restrictions in the beginning of this early stage in the market, meaning that institutional capital can or cannot participate in lending platforms. It's up to them, and it's up to the owners of the platform. Until the main principles of security are in place. So if the national bank, if the regulator wants platforms to follow all the regulations, to follow the debt-to-income ratios, etc., why do we need another regulation that legal entities which are lending through the platform has also follow these requirements? That's like double requirements for the same action. So there are quite a lot of things that we should think about in imposing such restrictions, because they are not logical and they don't give any opportunities for the market to grow. So our approach is that the market itself will decide whether there is a need for institutional capital or not, because companies can themselves start lending, and it's very easy to do that once you are in the consumer credit list. So why we should limit their possibilities in the market with lending through the platforms? We don't understand that.
I would argue that there's of course a concern from customer protection for the retail investors if institutionals come in. But this can be easily addressed by discussing the terms of the investment and making sure that it's transparent and the terms are the same, so that the retail investor has the same benefits than the institutional investor. I think again it's symptomatic then in countries where the thinking is potentially a bit more open. The UK, also France. In the UK, the first institutional investor that invested in peer-to-peer lending was a state bank, the British Business Bank. In France, the first bank that discussed lending as an institution was a business bank. In Portugal, you had a government fund being managed by a crowdfunding platform to do social investments through crowdfunding. So you have actually government institutions, like the ones we had earlier on the panel, that took the first steps and engaged. And if you do that, you set an example. You can also help create certain rules that protect customers and also enable the market to scale. And I think this is really where, I mean, again, I'm not in your discussion, and you are much more, but this is where the discussion should go to. If you want to have this country as a hot pot for peer-to-peer lending, then you better be open. You work on transparency, and you allow the market to grow. Because basically what is happening in other countries, like in France, like in Germany, like in the UK, is that the markets are scaling, and you see platforms that make 100 million euros revenues a year, and maybe 500 million, and soon they will have the scale and the money to be licensed as a financial institution. They don't have a problem with the regulatory burden anymore, and they will be able, under European passports, to expand into Lithuania and into the neighboring country and in the whole of Scandinavia, and operate with their model out of their home base. And so this is also something that you may want to consider, that you need, if you want to have a local industry, you need to have it grow, and rather quickly, because you're potentially slightly behind the other countries. And to do that, you have to be enabling, taking risk, and support it from the government side. So the mayor of Lisbon has crowdfunded his political campaign. I mean, how strong can your support be for crowdfunding? A major European party is considering, I can't say the name, but it's considering us, in the European Union, considering to crowdfund their party. It's a political party. Yes?
That's an interesting approach.
So there are people who think on much bigger terms. They want to use the tools, be it reward or whatever it is, to benefit themselves. But that is a political statement. And so this has to come here as well. Yeah? Your minister should say, we want crowdfunding, and we have to find ways to, develop these platforms. We have to create a framework that makes you grow. So when you talk about regulation, regulation is de facto nearly always negative. Unfortunately, it restricts something. We have a lot of regulation in Europe, too much. So everybody you will ask who knows about regulations, will they get rid of regulation or make it simpler? But regulators, of course, live off regulating things. You should create a framework, your regulator should create a framework that is enabling and that allows you to grow, and that unfortunately means to also take some risks.
So that's interesting. How do you create such an environment eventually? Like, brings us to the culture. I know to the questions of innovation, to the questions of culture and environment that we operate. Like, how do we eventually achieve this this aim of having a functioning market here?
You always need probably one or two thought leaders that are in a position to influence opinion. So in the European Union, in the Commission, the first one who spoke out on behalf of crowdfunding was Commissioner Neelie Kroes. She made a big support, verbal, no more, but nonetheless it was heard. And then the then Commissioner for DG Markt, or the financial regulation, hired a team and organized a conference in Brussels with 400 participants on the topic of crowdfunding. Then had a public consultation and published a paper on crowdfunding linked to the EU strategy of long-term finance. So if you're looking for a public symbol, there is one. If your government is reviewing financial regulation, that would be a symbol to publish a white paper on crowdfunding and peer-to-peer lending that is forward-looking and enabling. It doesn't necessarily mean there has to be legal actions or regulatory actions now. The European Commission has just published a paper aimed at member states how to market crowdfunding in all of its types to SMEs. It's not talking about the risk. It says, this is great, encourage it, grow the market, the rest will come. Yeah? So, but you need somebody who does that. In the French discussion, which has led to regulation, which is not all perfect. Yeah? Don't be wrong. I mean, there are limits of how much you can lend as an individual investor in the French market as well. But basically, you had a banking monopoly. So the banks had the ultimate right to do certain things. No other organization was supposed to do that. And they took parts of that away and allowed crowdfunding to act in a market that so far was only open to banks, without having the same capital requirements, the same regulatory burdens. That was a decision by the government. But you had ministers speaking up for crowdfunding. You had the Minister for Digital Society run a 1,000-person conference once a year on the topic of crowdfunding and discussing the topic publicly. So this is something you need to have. This is a small country that should be easy. One of you is neighbor of the Prime Minister here. I mean, statistically speaking, yeah? So you just have to pop over and say, can you please speak up for crowdfunding?
Yeah.
This is how it works in Malta, for example.
Thanks. So maybe, we've heard a lot of arguments here and pro and contra. Maybe as a final sort of note, what do you want the audience to take out of this panel on regulation, like in several words? Maybe you can, have a sort of final say on like what would be your advice to the national regulator to make a regime to stand out of the crowd? Like, Vytautas?
I think the main thing, as I'm involved, the main problem, I think that we cannot base a regulation on an assumption or on a notion that a consumer or investor is dumb. I think you cannot base a regulation on that, and I think that sometimes it is being like that. That we have to protect consumer because he's financially illiterate, and we have to do everything because we are saving almost the lives of people. And I think the regulation cannot be based on that. And this is one message would be for regulator: you have to base regulation on an assumption that people are somewhat they can reason and stuff. The second thing would be for a private industry. I think I'm working in a think tank, so I'm also involved into these issues. But I think the industry has to cooperate together. Have to say what they are thinking about regulation when it is being discussed. I think it's a crucial point because it would make my job easier, but it also would take your life easier too, I think.
Yeah, thanks.
Just a remark about consumers being a dumb person. I guess the dumb person cannot log into a crowdfunding platform, so by definition these people cannot be dumb. But summarizing
on behalf of their parents,
the ideas of this panel, I believe that regulation is good because it adds credibility. But regulation has to be proportionate. And also, Lithuania is a small country, and Lithuania has to think how to promote itself among other European countries. Why not to be the center of best crowdfunding providers in Europe? But for that, you need a very competitive regulation. So I think it's a challenge that everybody is aiming at.
Thanks. Vytas, maybe you have something to add here?
Yeah, from our perspective, again, tax issues. The main thing is the tax issues and who pays what to whom and when. And the platforms, I would like to see our platform as the subject which is paying the taxes, because then we can really be sure that the taxes are payable. So this is the main thing from our investors, which comes to regulation. In regards to regulation, again, like Thomas said, regulation is good. We stand for regulation. Regulation has to be proportional. It has to be a separate law, and there has to be main principles. What protection we should do to make sure that the borrowers are protected and the investors are protected. Everything else, the market will set up. It's a very competitive market. There are so many players in the market, and everything will be really set up by the market.
So thanks for your opinions. We've heard a lot of arguments here, and I think the audience can take their own view on whether we need regulation, how do we regulate it, and eventually probably the lesson to take here is that we need good examples and we should learn from the best. Probably UK is the best one to learn from, but maybe the regulator would take some other countries to draw influences from. But in any case, thanks for your time and for your thoughts on this topic. So maybe you have questions.
Thanks for a nice, interesting discussion. The most interesting question to me was, can the sector regulate itself? So judging from the panel, I kind of got an impression that despite some statements that proportional regulation is good, somehow I got a feeling that the market and the sector could potentially regulate itself. And I think I strongly disagree with that. And an example I'd like to make is it's a growing market, and there were many fast-growing markets in the financial sector that we all know how they ended up. examples are multiple, and consumers were eventually proven to be actually dumb and needed to be protected from themselves. So my question would be, if we scale the P2P lending to at least, let's say, half the banking industry, and it's really a major force to be reckoned with, what do you see would be the biggest risks that can go wrong if it's lightly regulated? Thank you.
My comment would be, we need like 20 years to scale a P2P to half of the banking industry. So if we will have up to 10% of P2P in the banking industry within 10 years, that's a great achievement, because that's still a lot of money. Comments regarding regulation. Peer-to-peer platforms have the main principle. Jens stated early in the second panel that your decisions can be very costly, basically. So if we make bad decisions in the platform, we will feel it within 6 months, because the money will not be paid back, investors will not lend through the platform, and basically you will close the business. So this is the main self-regulation principle that we have. So we cannot lend the money to dumb people, if we can say that. We cannot do other things that we would like to do if, let's say, we are not regulated. It doesn't work that. The market is very regulated, because there's so many competition in the market. So you have to be a higher standard. And the thing that borrowers has to repay the money every month, and once they stop paying, it's the main principle of regulation. You have to be transparent and have to work a lot to avoid that.
Dear panelists, maybe anybody wants to comment on that, or?
No, I think it's mostly right. I think I would transparency. We have the issue of money laundering, so platforms have to be very transparent about where the money comes from, how they deal with the customers, and make that also understood to the regulator. There's the issue of platform risk. I mean, if a platform like, it's of course not going to happen there, but just assume a platform like Trustbuddy goes bankrupt, and then what happens to the outstanding loans? How are they being repaid? Who's going to do that? So an industry has to find a solution to that as well. In the UK, they have worked on that, in other countries as well. So you have to have a fallback situation for these type of situations. And this is something that is not going to be regulated likely ever. This is something that the platforms have to build in the ecosystem. And I think this is the step that has to be taken.
Thanks. Any other questions?
Hello, my name is Domas. You almost answered my question, because I have heard the discussions from two aspects of P2P lending platform. And one aspect, which is about to be regulated, the amounts invested by the investors to the platform. I believe it's the same like regulating the billboard, where everybody can post the note that he's going to borrow or lend some money. The second aspect about regulating the somehow measured possibilities of returning the loan for every borrower. I don't think it should be regulated, because if the platform states the data wrong or makes mistakes, it will fail the loan givers. However, one of the aspects you mentioned in the very end is what is going to happen with all the data about the issued loans when the platform goes bankrupt, and it might eventually happen. And I believe that's the most important aspect, which should be regulated and stated in the bank's notes about who is going to take care of about everything. So if you can comment on this a bit more. Thank you.
Yep.
The comment regarding, if I understood the second question correctly, what would happen if the platform goes bankrupt? So presently, we are building up the solution that to ensure the continuity of the platform, and it will be in place very soon. But basically, what we see, our solution is based on the transfers directly between two people, and money comes from one account to other account. So to run this particular part of the system which ensures the payment, it is very very easy. So if the company starts its activity, the transfers, the direct transfers, they will be maintained. So we don't see any reason not to ensure this point.
And I think from a strict legal perspective, there is a big difference when the platform goes bankrupt and when the bank goes bankrupt. So when the platform goes bankrupt, still the investor technically can chase the borrower. But if the bank goes bankrupt and you cannot recover your whatever parts of deposits, you cannot chase the borrowers of the bank. So there is a big difference, and I still believe that if you look, crowdfunding platforms would never, even in an unlikely event they'll form up 50% of the financial industry, will never pose a systemic risk, because you can repack all the package and narrow down to every single, so to say, contract.
And it's also, any other comments?
Yeah, very small comment. When we talk about regulation, I think we have to talk about different aims of regulation, or because one aim of the regulation can be to reduce the regulatory uncertainty. Because in this case, for example, we just don't know, according to the law, what will happen. And I think this is very good aim of the regulation. The second aim of the regulation is, of course, increase consumer investor protection. And I think this also has to go only to some extent. I mean, sometimes I think we can overdo that. I mean, this 2-day, for example, calm down period, I think it's already overdoing the consumer protection. So I completely agree, and we have to talk about reducing regulatory uncertainty, and this is very, very important. I think also what we have to do, we have to find a balance in consumer protection. So I think we have to distinguish between these two different aims of regulation.
Thanks. Any other questions? Yeah, that would be interesting to hear, actually. No, but
I believe we have representatives of the National Bank and representatives of Ministry of Finance here, so we are not alone here. So we have to watch what we say.
Yeah. I mean, we have, but they are currently they are here, but I believe we shouldn't force them to say anything about it. And again, the approach of National Bank, as I spoke earlier, it's very favorable. We have the political decision to have crowdfunding in place. So that's the main principle that we should celebrate. How we can achieve the main regulation, it's during discussions and meetings with the National Bank and in the committee, I believe we can find one solution which favors everyone. So I think we are in the beginning of the long-term journey, and I'm looking forward to have like really good proportional regulation in Lithuania.
Mantas, you wanted to ask something?
Yeah, I wanted a follow-up question because some other points got mentioned again. You were saying that, well, basically the idea was that there's no systematic risk in the P2P lending, which I'd like to question, is there really not? Because you said in the event that the platform goes bankrupt, you can basically track down every individual who has took a loan out of the platform, or out of the other of the loaners to the platform, which comparing to the banks, well, potentially you could do that as well. Banks also have assets, right? So, and in the event of their bankruptcy, they have procedures for tracking everyone down and getting back their money. Meanwhile, they are also providing money to those who had deposits in the banks. So, if the platforms are huge, the money that could be put in the platforms is also pretty much. So saying that you can track down every individual who has took out a loan. This is not very practical, I think, and could take a lot of time, in which case the government would need to kind of step in and do something about a lot of people losing a lot of their money. And so there is a systematic risk, I think. Another risk, which I kind of tried to make point beforehand, is that there's potential for fraud. We saw 2 banks failing in Lithuania, and that is, well, mainly, well, the version is that mainly due to fraud. So is there no such thing possible in the platforms? I mean, they can claim to be transparent, but if they're just faking everything, what can you do about it?
Yeah, believing that platforms can be fraudful is wrong, because to run a organization based on fraud, you have to have a long-term money to pay the investors. So you can have like short-term fraud activities, issuing a loan to your friend or whatsoever, and not returning it back. So once you do that, and once you do it in scale, your investors will stop lending. So you will stop your fraud activities very quick. So we don't see any systematic risk here. But I'm speaking about peer-to-peer lending. There's a very good column in Bloomberg about Lending Club like 1 year ago, and basically it says about regulation of the capital requirements. So we see P2P platforms as 100% equity-backed loans. So basically your investment is backed by a loan directly. There is no capital requirements on the platform. So we don't, there's very big transparency. You know whom you lended, and you have your claim direct to that person. So it's 100% backed requirement, like claim. So it's very secure.
There's no leverage.
And I think one comment, when we talk about systemic risk, it's not the question how you trace your money is rather secondary. I still believe that with a platform it's much more easier, because legally you would have a title against the borrower. But when you talk about systemic risk, you should answer the question whether the failure or bankruptcy of platform would drag down all the financial industry. Most likely not. The failure of a large bank would drag down the financial industry down.
And I just about the issue of fraud. We talk about peer-to-peer lending today. We don't know how it looks in 20 years. I mean, we have assumption about this, but peer-to-peer lenders are usually not payment providers. So the payment provision of the transaction is not done by the platform themselves, but by a licensed third party that is fully regulated. So therefore, the transaction of the money is not, the money is not at the disposal of the peer-to-peer platform in most cases. Also, when you reach scales and platforms become bigger, they very often have some reserve funds in case there is default or some other issues, so they can repay lenders. And then we have that already with the Dutch example. They don't have any default rates at that level. And there are also, for in your case, if you have let's say you scale up and you have 1 million transactions, and you as an individual have invested, I don't know, 50 times 150 euros, and the platform goes bankrupt. You're not going to have, I don't know, 50 court cases in order to get your money back. I mean, that's not financially viable. So platforms, so you would actually effectively have lost your money. So a lot of the platforms, the larger platforms, start building kind of with third parties again, kind of a mirrored transaction base, so that if they should break down, there's a third party that has a record of all the transactions and can do the follow-up in that case. And so you would still be able to get to your money. But of course, to be able to build these kind of systems, you also have to have the scale, and the industry has to grow. To expect that from a startup, it's not realistic.
Thanks. So thank you. Okay, one final question.
Well, I'm interested in the statement that one crowdfunding platform would collapse and that wouldn't impact the financial industry. As you said, that's absolutely correct, but I would like to say that would impact the reputation of crowdfunding, and that is still a pretty novel concept. Some platforms that are obviously bigger, they can install financial payments provider, have the so-called custodian agent in place. So these are really good tools to ensure safety and security. But at least in the Netherlands, you've got over 100 platforms. A lot of them are really tiny. And so financially, they're simply not able to comply with or install these. security measures. So I think the part of regulation is also, of course, to ensure that, well, these kind of laggers in the industry or failing platforms wouldn't happen, and that wouldn't damage the growth of the industry itself. So that was my statement.
Truly,
Thank you.
Very good points. Everything about trust.
Well, so let's close on that note. Then it's quite positive. Also, thank you for your time in attending, and judging by your patience, this crowdfunding has a future in Lithuania.